InvestSense market commentary for the last week of June 2025 and for the financial year 24-25 as a whole as well. Now, we've been playing with this concept of the what then the why, riffing off that thing with YouTubers where they tend to give you the what at the end because they want you to watch the whole thing. Well, of course, we'll give you a bit of a summary up front because we don't really care. Love you to stick around. But if the what's what you're interested in, first of all, last week, well, not an awful lot happened actually. You had Japan up by a couple of percent and then down again and finishing up more or less where it started. And you had gold down a bit, up a bit, everything else somewhere in the middle, oscillating within a 1% band, and nothing really moved markets very much, apart from bond markets started to get a little bit more edgy. Now, some of this might be down to trade wars. That's fair to say. We have been in a little bit of a holding period recently, and if you remember 6 weeks or so ago, a lot of these trade deals were pushed out, or there were negotiations, or tariffs were suspended, the most extreme ones, until 2nd or around the 9th of July. So that's starting to bubble up again a little bit, and you're starting to see some of those headlines come through. Last week it was Canada who actually ended up capitulating to some extent on the digital services tax, and that's something that we've got in Australia and in Europe as well, so we're probably going to hear more about that in the next few weeks, and one where Trump probably got some gains. On the other hand, we're seeing a lot of central banks get more dovish. You had Jerome Powell last week admit that if it wasn't for a lot of this uncertainty and the tariffs and the potential impact that they don't really know how to assess yet on inflation, they'd probably be cutting because of the weakness that they're starting to see in economies, and that can kind of go both ways. You've got to be careful what you wish for, but certainly there's a sense that central banks are coalescing around the idea that inflation is on the ebb and interest rates might be on their way down. That was certainly the message also from the Bank of England, and as we discussed last week as well, the RBA on a weaker inflation print probably has a little bit more room for manoeuvre. The market's pegged 3, maybe 4 cuts so far this year if things don't get worse. Now, at the other end of the spectrum, we've got the big beautiful bill being pushed through, and it looks like it'll get through. It's edging its way through, maybe not by the 4th of July deadline that Trump imposed, and that's pushing yields the other way, and that's maybe why you're seeing a little bit of volatility out at the sort of 10-year level. We've also got this week a conversation with Andrew Hunt where we talk about the fact that things might get a little bit more rocky in the next few months as the markets start to think about how these deficits will be paid for. We've also got Andrew coming out next week, and we'll have a more in-depth interview with him as he conducts some research on the Australian economy as well. So there's going to be lots to talk about then. And of course, advisors taking a bit of a breather now after what was probably a busy end to the year, probably not thinking about markets too much, but we're starting to package some stuff together so that you're ready. But we're starting to package some stuff together, ready for conversations that you might be having with advisors in the next few weeks post the end of the financial year. And basically, it's going to be a pretty good news story. So it was a year of two halves, as they say in football. At the end of last year, probably pretty fizzy. Markets were up about sort of 20%, but led by the US, led by the Mag 7. And there was a sense that things were quite polarized. And then so far this year, we had a rotation earlier in the year, benefiting Europe, the UK, emerging markets, global small caps. So there was definitely that cyclical emphasis to it. And also a sense that maybe last year all the talk was about US exceptionalism, and ironically it was maybe this year more about the end of US exceptionalism, and perhaps unexpectedly with Liberation Day that narrative actually accelerated, and we've seen that in the fund flows, for instance, a lot of people investing more outside of the US, even though, as Andrew will say, a lot of other things, other cash holdings by foreigners in the US haven't been repatriated yet. We are seeing some movement and a weaker US dollar. So when you put that all together, basically for the year, we've seen Europe, global small caps, the UK up by 20%, followed after that by Japan and the US, and a sort sort of more moderate 10% return from Australia, where we've seen a lot of polarization in the market. Obviously, things like CBA and other expensive defensive like Wesfarmers doing reasonably well, but a lot of the market actually pretty moribund, especially some of the exporters. So what does that mean for diversified multi-asset funds? Well, you can see here So what does that mean for diversified multi-asset class funds? Here we've got 70-30 funds in red for more passive funds, and the blue line shows the average active multi-asset fund. And this is a pattern we've seen over the last 5 years, where active asset allocators and actually active fund managers as well have lent against this. They've sort of leaned into the cheaper assets outside of the US, or less CBA and more CSL, things like that. And what you've seen is basically lagging when markets have gone up, but more capital protection when they've gone down. And given that markets are up by about 12% for a passive fund, 70-30, and about 10% for a active multi-asset fund on average, you can see that means that the average active fund has underperformed by about 2%. Now, this isn't usually the forum where we talk about our own fund returns, but for our own clients' benefit, it's probably worth saying that even though we're just looking at estimates at the moment, not all the distributions are in, but it looks like our funds have sort of kept up with the passive Joneses, but with also less risk as well. So it's been an okay year. But overall, the message is up by 10% or so if you're a 70-30 investor, a little bit less if you're more defensive, a little bit more if you're more aggressive. It's actually a pretty good conversation to have with clients, notwithstanding the fact there's actually been quite a lot of volatility. Now, when you look at it in risk-adjusted terms, you can see there's a pretty straight line there from bottom left to top right, which tells you that, as this sort of pithy title tells you, there's been no risk-free lunch, as it were. And it's just been a question of how much risk. And you had a little bit of a wake-up call earlier this year with markets sort of giving all of that just about back, but then they bounced back. And basically, the question now is, are we getting back to that sort of frothy period? Something that we talk about with Andrew in this week's conversation. The other thing that advisors will be interested in is how do these returns compare with industry funds? And you can see that basically in a higher interest rate environment, with maybe some indigestion in private equity and other directly held assets, private assets that have been difficult to sort of revalue them upwards, industry funds as a whole have lagged reasonably significantly again, probably for the third year in a row. Obviously, not all of those industry fund returns are in, and in a few weeks, when those numbers come in, we'll delve into that in a bit more detail. But what we'll cover in more detail next week, and we're getting more into the why of things if you feel like tuning out, is what's happened between, say, sort of growth and value, US versus the rest of the world. And you can see there are some clear dynamics there. As I mentioned before, in Australia, the active managers had a fairly difficult year. And it's very clear when you look at the underlying holdings, none of them own CBA, or they're as underweight as they can be. They're overweight in things like CSL. And that sort of proved expensive in relative returns. Time will tell whether that's the right call. Overseas, it's been Magnificent Seven versus the rest. And, value versus growth, it's really been, whether you've got a market weight, say 70% in the US, or whether you've been more biased towards Europe. And that's where things get a little bit more granular. Now, in the growth manager category, it's really, again, on that risk return spectrum. If you've taken more risk, you've had more return, but you've had more volatility. In the value manager category, and this is something that we will delve into a little bit more next week, it's a little bit more all over the place. And you've seen some big dispersion in terms of risk and return. And basically the sense that some managers have really got it right, and some managers have been a lot less lucky. And we'll delve into that in a little bit more detail within the Australian market, within the international markets next week. We'll also look at fixed income returns, but it's a pretty easy narrative. If you've had a lot of duration, it's another year where it's been a sort of return-free risk from duration, whereas credit, if you've had a lot of credit, you've actually done pretty well, and it's been the opposite. It's been almost, at least looking backwards, a risk-free return. where credit spreads have come down pretty much with a little bit of a bump earlier in the year, but it's been a pretty much a gradual progression, tighter and tighter, arguably not really priced for a recession, but if you've had a lot of credit last year, you've probably done quite well. But the star performer, as we mentioned before, has been gold, up by 40%. And again, delving into the why of these things a little bit, just to finish off, we get asked that question a lot of the time, and it's really quite difficult. Some times you can track the performance of gold relative to the real interest rate, or as a crisis hedge, the sort of ebb and flow of uncertainty. But really probably the prime reason that we've seen, at least with a couple of years perspective now, and this is a chart from Goldman Sachs, you can see it's the extent of central bank buying, which really accelerated, especially outside of Western economies, after the Russian invasion of Ukraine, when the US froze some Russian assets, and a lot of people started thinking about where their reserves were being held. And the next chart you can see is, even though you might say a lot of that's already happened, and the gold price is up 40% so far this year, so has it run its course? And obviously it's a very difficult asset to value with no cash flows. But then, as this other chart from Goldman Sachs shows, the top part of this chart shows that it's a very normal thing for a central bank to have a lot of its reserves in gold. But there's a lot of central banks like China, Switzerland, India, Japan, that are probably over-reliant on US treasuries, and this could have some way to go. So that's why, even if you've had a good year with gold, maybe it's still worth having some in portfolios. So even though gold's had a good run, you can still probably argue it each way, and certainly speak. So even though gold's had a good run, you can probably argue it each way. So next week, we'll delve into some of the drivers. So next week we'll probably So some of those numbers that we showed you before, they're only estimates at the moment. We should have firmer numbers next week or the week after. And one of the big swing factors, especially those international equity funds, some of them have big distributions, and they can move around a little bit as unit prices get set after the financial year end. So we'll delve a little bit more into what's been driving international equity returns. We'll also talk a little bit more about what's been happening in the domestic market, and then after that we'll look at some of the industry fund performance relative to retail equivalents in passive and active, and then with the aim of, in a few weeks, having a little bit of a package put together for you before you talk to clients when you're doing their financial year end reviews. So look forward to fleshing out some of these issues a little bit more in the next few weeks. Thank you.